Hey friends, welcome to today's Singapore Market Digest. I'm Wei from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Grab your copy and let's dive into what's happening in our local market scene. You might have heard the buzz about DBS lately, and there's a good reason for that. Singapore's largest bank just made a power move in China that's worth talking about. Think of it like upgrading from a regular coffee shop to owning part of the whole kopitiam chain. DBS has increased its stake in Shenzhen Rural Commercial Bank from 16.7% to 19.4%, and here's why this matters. This expansion into China's Greater Bay Area isn't just about bigger numbers. Imagine the Greater Bay Area as Orchard Road times 20. It's a massive economic powerhouse linking cities like Hong Kong, Shenzhen, and Guangzhou. For DBS, this is like getting a bigger slice of a very profitable pie, and they're doing it without breaking the bank by using their own cash reserves. The market seems to agree with this strategy. DBS shares closed up at $43.60, gaining 0.09. That might sound small, but in banking terms, it's a vote of confidence from investors. What makes this move even more interesting is how it fits into DBS's broader strategy of becoming a major player in Asian banking. Now, let's switch gears and talk about something that affects many Singaporean investors, REITs. If you're new to investing, think of REITs as being a landlord without actually owning an entire building. You get to collect rent in the form of distributions without dealing with tenant issues. Keppel REIT's latest numbers tell an interesting tale. Their second half DPU, that's distribution per unit, think of it as your share of the rental income, dropped to $0.28, down 3.4% from last year. Now here's where it gets interesting. It's like having more tenants paying higher rent, but also having a bigger mortgage payment eating into your profits. Their revenue jumped 15.5% to $136.5 million, and their net property income grew 13.6% to $105.1 million. That's like having your rental income go up nicely, but then your loan payments increased even more because of higher interest rates. The REITs units closed at $86, down 1.1%, showing that investors are still processing these mixed signals. Here's a bright spot in our REIT landscape. Capitaland India Trust, or CLINT as we call it, has been making some smart moves in India. Their second half DPU grew by 3% to 0.032, and their full year numbers look even better with a 6% increase to 0.06984. Think of CLINT's strategy like this. Instead of just collecting rent from existing properties, they're also buying new buildings and getting more tenants. It's like expanding your property portfolio while your current properties are doing well. Their units stayed steady at $1.04, suggesting investors appreciate this balanced approach. AIM's APAC REIT reminds me of that reliable friend who might not make headlines but always delivers. The 9-month DPU increased by 1.1% to $0.0707, while revenue grew by 5.7% to $139.1 million. In today's challenging market, steady performance like this is worth noting. Their units maintained their position at 1.27, showing investor confidence in their stable approach. Let's zoom out and look at the bigger picture. The Singapore REIT sector in early 2025 is navigating through some interesting waters. Higher interest rates are like strong headwinds. They make it harder to move forward, but the best REITs find ways to adapt and grow. What's particularly interesting is how different REITs are handling these challenges. Some, like Capitaland India Trust, are focusing on growth in emerging markets. Others, like Keppel REIT, are working on optimizing their existing portfolio. It's like having different strategies to win the same game. For those of you thinking about investing in these companies, here's what to watch for. In the banking sector, DBS's China expansion shows how Singapore banks are becoming major regional players. It's not just about local banking anymore. It's about capturing opportunities across Asia. In the REIT space, keep an eye on interest rate trends. When interest rates change, it affects REITs like how changing weather affects your daily plans. You need to be prepared and adapt accordingly. Look for REITs with strong tenant bases and healthy debt levels, as these are better positioned to weather any storms. As we move further into 2025, the Singapore market continues to show its resilience. Yes, there are challenges, but there are also opportunities for those who know where to look. Whether it's DBS's strategic expansion or the various approaches taken by different REITs, our market remains dynamic and full of potential. If you found this market update helpful, don't forget to like this video and subscribe to the Investing Iguana for more Singapore market insights. I also take this opportunity to wish all readers a happy Lunar New Year. May the year of the snake brings more success and prosperity for everyone, especially in your investments. Cheers!